Taxation of insurance businesses and financial institutions. Insurance is a risk transfer mechanism by which an organization can exchange its uncertainty for certainty. It is worthy to note that insurance does not prevent the risk from occurring. It, however, provides a means by which individuals and entities that are exposed to a risk or risks to transfer their financial consequences of the risks to an insurance company, herein the insurer, in return for the payment of premium. The principle is that all organizations or individuals that are exposed to a particular risk contribute their financial resources in the form of premiums, which is invested. Insurance work on the law of large numbers. This is because the few who suffer any losses are compensated from the contributions of many. Distinction. A distinction is sometimes observed in the usage of the terms assurance and insurance. Insurance contracts and assurance contracts. So contracts, the former being particularly confined to life insurance business, while the latter term is used to denote insurance contracts covering events which may occur or may not occur, such as fire, theft, accidents, etc. In addition, Section 89 of Act 896 indicates that any other business activity of a person who conducts a general insurance business is separate business from the general insurance business, and the income or loss of that person from each of the business for a year of assessment is to be computed separately. Also, Section 90 prescribe equality. That's prescribe equality. That is, any other business activity of a person who conducts a life insurance business is a separate business from the life insurance business, and the income or loss of that person from each of the businesses for a year of assessment is to be calculated separately. Go again on this, that Section 90 prescribe equally that any other business activity of a person who conducts a life insurance business is separate. It's a separate business from the life insurance business, and the income or loss of that person from each of the business for a year of assessment is to be calculated separately. General business. For general business, the company needs to prepare accounts to determine its profits so that corporate tax rate of 25% will be applied on their chargeable income to ascertain the tax liability. In the accounts, what constitutes income can be referred to in Section 89, subsection 2a. We are looking at what constitutes income. A premium derived by the person in conducting the business during the year of an insurer or reinsurer. This includes gross premium income and reinsurance premium. Then B, we have proceeds derived from the person under a contract of reinsurance where the events that determine liability have occurred. Let's look at this. Expenses of general business and what it includes. This can be referred to in Section 89, subsection 3. This includes A, proceeds incurred in conducting the business by the person as an insurer or as reinsurer during the year. B, premium incurred by the person under a contract of reinsurance in respect of proceeds referred to in paragraph A during the year, and C, the amount of any reserve for unexpired risk in respect of that business as at the end of the basis period. The rate is determined by the Insurance Act and their amendments. Now, looking at general business in insurance, there is general insurance business, referenced Section 89 of Act 896. We look at general business insurance. For purposes of this Act, any other business activity of a person who conducts a general insurance business is a separate business from the general insurance business, and the income or loss of that person from each of the businesses for a year of assessment is to be computed separately. 2. Where the income derived from a person from insurance business for a year of assessment is to be determined. The person during the calculation shall include a premiums derived by the person in conducting the business during the year as an insurer or a reinsurer, and B. Proceeds derived by the person under a contract of reinsurance in respect of proceeds referred to in subsection 4A during the year. 3. Subject to Section 8, a person shall, in calculating income from general insurance business derived by a person for a year of assessment, deduct a proceeds incurred in conducting the business by the person as an insurer or as a reinsurer during the year, and premiums incurred by the person under a contract of reinsurance in respect of proceeds referred to in paragraph A during the year, and C. The amount of any reserve for unexpired risk in respect of that business as at the end of the basis period. For purposes of section 23 subsection 3, proceeds incurred by a person as a general insurer are payable and may be deductible under subsection 3-4, where A. the events that determine liability have occurred, and B. the proceeds can be deducted in accordance with the generally accepted accounting principles. After the general insurance business, we are moving to the life insurance business, as stated in Section 90 of Act 896. 1. For purposes of this Act, any other business activity of a person who conducts a life insurance business is a separate business from the life insurance business, and the income or loss of that person from each of the businesses for a year of assessment is to be calculated separately. Where the income derived by a person from a life insurance business for a year of assessment is to be ascertained, the person doing the calculation shall A. exclude from the income the following items, and the items excluded shall not be regarded as consideration received for an asset or liability. I. Premiums derived by the person as an insurer or a reinsurer, and II. Proceeds derived by the person under a contract of insurance in respect of proceeds referred to in paragraph B, I, and B. Not deduct from the income the following items, which are not to be included in the cost of an asset or liability. BI. Proceeds incurred by the person as an insurer or reinsurer, and II. Premiums incurred by the person under a contract of reinsurance in respect of proceeds referred to in subparagraph I. Now, looking specifically at the proceeds from insurance as Section 91 of Act 896. 1. Subject to subsection 2 and sections 89 and 90. For the purposes of calculating the income of a person, the proceeds derived by that person from insurance is determined in accordance with Section 29. 2. Subject to Section 90, a gain of an insured person from life insurance SA exempt from tax when the proceeds are paid to the insured person, where the proceeds are paid by a resident insurer, and B, included in calculating the income of the insured person, where the proceeds are paid by a non-resident insurer. 3. For purposes of this section, gains of an insured person from a life insurance means the extent to which proceeds from the life insurance paid by an insurer exceed premiums paid to that insurer with respect to the insurance. Interpretation, Section 92 of Act 896. In this division, unless the context otherwise requires, general insurance means an insurance that is not life insurance, and life insurance means insurance of any of the following classes: A, insurance where the specified event is the death of an individual who is the insured or an associate of the insured. B, insurance where the specified event is a personal injury sustained by the insured or an associate of the insured, or the incapacitation of an individual who is the insured or an associate of the insured. And II, the insurance agreement is expressed to be in effect for at least 5 years and is not terminable by the insurer before the expiry of 5 years, except in circumstances prescribed by regulations. C, insurance under which an amount or series of amounts is to be payable to the insured in the future. Then D, reinsurance of insurance referred to in paragraph A to C. Now we look at the regulatory framework. In Ghana, the business of insurance is regulated by the Insurance Act 2006, Act 724, as amended, states the classes of insurance business as follows. So these are the various classes of insurance businesses. We have A, life business. Then B, non-life insurance, which consists of fire insurance, marine insurance, transport and aviation insurance, motor vehicle insurance, workmen's compensation insurance, any insurance business other than the foregoing, and C, reinsurance businesses covering any or all of the following business. The Income Tax Act 2015, Act 896, mentioned two classes of insurance businesses, namely life insurance business and general insurance business. According to Section 92, life insurance business has insurance of any of the following classes: A, insurance where the specified event is the death of an individual who is the insured or an associate of the insured. Insurance where the specified event is a personal injury sustained by the insured or an associate of the insured, or the incapacitation of an individual who is the insured or an associate of the insured. And II, the insurance agreement is expressed to be in effect for at least 5 years and is not terminable by the insurer before the expiry of 5 years, except in circumstances prescribed by regulations. C, insurance under which an amount or series of amounts is to become payable to the insured in the future. And reinsurance of insurance referred to in paragraph A to C. The same section refers to general insurance business as any insurance business which is not a life insurance business. We now look at premiums. In order to effect insurance, the insured must first complete a proposal form which will then become the basis for the contract between him and the insurance company or firm. If the company is satisfied with the information provided by the insured on the proposal form, a document called policy is issued, which then completes the contract. The amount payable on acceptance by the insured of the proposal form the firm is known as the first premium. Subsequent premiums are known as renewal premium. Usually, premiums for life insurance are payable annually in advance, but monthly, quarterly, or semi-annual premiums are acceptable by certain insurance companies in Ghana. Premiums for other classes of insurance such as fire, motor, burglary, accidents, etc. are always payable in advance. Viewers must note that unlike life insurance premiums, which are continuous in nature, non-life premiums expire as soon as the premium payable period is over. The insured will have to pay another premium for the coming year in order to claim compensation should any eventuality befall on him. When large amounts are insured, insurance companies normally reinsure part of the risk undertaken. What this means is that the company which undertakes the risk in the first instance pays to another company a premium for the right to recover part of the original sum assured as and when a claim occurs. Such insurance contracts are quite distinct and separate from the original insurance, and any right accruing under the reinsurance policy vests only on those companies who are parties to reinsurance contracts. The original person insured has no rights under it. Premiums represent the sales revenue or turnover of an insurance company. They can arise mainly from a direct business such as the insured person and also from an indirect business as a result of the acceptance through a reinsurance agreement. Premiums are amounts receivable by an enterprise for underwriting risk. Direct business is all business where the insurer has direct contractual relationship with the insured. This includes co-insurance business. Reserve for unexpired risk. Another important term associated with insurance premiums is reserve for unexpired risk or provision for unexpired risk. This is an allowable item on the negotiated percentage of net premiums income, which has for some time now been 40%. The rationale is to enable claims to be met. It is applicable under general fire, accident insurance, etc. Act 724 of Insurance Act defines reserve for unexpired risk to mean the reserve to be maintained by the insurer. One can finally define earned premiums as the premiums earned in an accounting period to meet the risk exposure of the enterprise during that period, adjusted by the unearned premiums provisions at the beginning and at the end of the accounting period. Move on to claims. Claims means the amounts payable under a contract of insurance arising from the occurrence of the insured event. Shall we go again? Claims mean the amount payable under a contract of insurance arising from the occurrence of the insured event. Included in the claims are expenses incurred by an insurance company which are incidental to the handling of claims. Claims handling expenses are expenses incurred by an insurance company in the process of investigating and settling claims, either by use of its own staff or by the services of third parties. They can either be direct or indirect. Direct claims expenses are those which are readily attributable to a particular claim. Where the handling expenses are not readily attributable to a specific claim, it is termed as indirect claim expenses. Claims arising out of the events which have occurred by the end of the financial period that have not been reported to the enterprise by that date is called claims incurred but not reported. That's into brackets IBNR. Incurred but not reported. Claims outstanding are the estimated final cost of settling claims arising from the events which have occurred by the end of the accounting period, including incurred but not reported and claims handling expenses, less the amount already paid for those claims. The claim incurred is determined as follows. Claims paid, then you add outstanding claims at the start of the year. In addition, claims incurred but not reported are added. Then you less these out of it. Outstanding claims at the end of the year, reinsurance recovered. Then when you do the minus and the pluses, you get your claims incurred. Now we move on to determination of chargeable income of general insurance business. How to determine the chargeable income of general insurance business. The income of a person from general insurance business is taxed under Section 89 of Act 896. 1. Any other business activity of a person who conducts a general insurance business is a separate business from the general insurance business, and the income or loss of that person from each of the businesses for the year of assessment is computed separately. 2. Where the income derived by a person from general insurance business for a year of assessment is to be ascertained. The income of such a person will comprise a premium derived by the person in conducting the business during the year as an insurer or a reinsurer. It should be noted that the premiums returned to the insured are excluded from such income. Proceeds derived by the person under a contract of reinsurance in respect of proceeds referred to in subsection 4A during the year. C. Subject to Section 8I, a person shall, in calculating income from general insurance business derived by a person for a year of assessment, deducts II proceeds incurred in conducting the business by the person as an insurer or as a reinsurer during the year. II premiums incurred by the person under a contract of reinsurance in respect of proceeds referred to in paragraph A during the year, and IV the amount of any reserve for unexpired risk in respect of that business as at the end of the basis period. For a purpose of Section 23, subsection 3, proceeds incurred by a person as a general insurer are payable and may be deductible under subsection 3A, where I, the events that determine liability have occurred, and II, the proceeds can be deducted in accordance with generally accepted accounting principles. The format for determining the chargeable income of a company as an insurance company is presented as follows. I present it to you for your perusal. Now let's look at the treatment of dividend. Resident company that receives dividend from another company following part ownership of 25% or more, the paying company will not withhold tax. However, the receiving company will have to add the dividend as other income and should be taxed at the corporate tax rate or the rate of tax applicable to the entity concerned. The interest from investment. Let's see how to treat the interest from investment. The interest from investment would have to be grossed up and added as other income, where such interest on investment has suffered the withholding tax. When the tax is determined, the taxes withheld should be deducted before arriving at the net tax payable. Question. Let's try to solve this one. It's an illustration. The managing director of Suka Insurance Company Limited presented a draft of the company's financial statement for the year ended 31st December 2019. The details are as follows. Premium retained 14,000. Insurance recoveries 43,000 Ghana cedis. Gross premium received 980,000 Ghana cedis. Reinsurance premium paid 25,000 Ghana cedis. Claims settled and paid 400,000 Ghana cedis. Commission to agents 18,000 Ghana cedis. Dividend received 22,500 Ghana cedis. General and administration expenses 44,800 Ghana cedis. Investment in treasury bills 737,200 Ghana cedis. Reserve for unexpired risk created for the previous year amounted to 474,500 Ghana cedis. It is the policy of the company to estimate reserve for unexpired risk at 40% on premium earned during the year. The company was granted a total capital allowance of 137,800 Ghana cedis required. Determine the chargeable income for Suka Insurance Company Limited on the basis that it deals in general business and its tax liability. So this is the suggested solution. Suka Insurance Company Limited computation of chargeable income for the 2019 year of assessment. Basis period is from 1st January 2019 to 31st December 2019. Now we have the gross premium to be 980,000 Ghana cedis. Premium returned. These should be deducted, and reinsurance premium too should be deducted of 14,000 Ghana cedis and 25,000 Ghana cedis. This 14 and 25,000 amounts to 39,000 Ghana cedis. We deducted from the gross premium, get 941,000 Ghana cedis. Unexpired risk. It was stated that unexpired risk at 40% on premium earned during the year. We're slashing 40% on the net premium. We get 376,400. In previous year risk, we bring it on board, giving us a positive figure of 98,100. Claims settled or paid 400,000. Reinsurance recoveries 43,000. Our commission to agents 357,000 Ghana cedis. And general and admin expenses, we have 18,000. That's 44,800, and commission to agents of 18,000 Ghana cedis. When we do the lesson and the grossing, we get 619,300 Ghana cedis. We come to less, deduct our chargeable capital allowance of 137,800, which was given us in the question. We arrive at the chargeable income of 481,500 Ghana cedis. We apply the tax rates at the rate of 25%. We get 120,375 Ghana cedis. So this should be less from the amount of 481,500. We arrive at a chargeable income of 361,125 Ghana cedis. Determination of the chargeable income for life insurance business. The determination of chargeable income for life insurance business is different from what we saw in the general business. Life assurance business is accounted for on the fund accounting basis because underwriting results is not determinable with reasonable certainty in the immediate future. The profits of life insurance company can be ascertained only by means of an actuarial valuation of its liabilities in comparison with its assets. The income of a person for a basis period from a life insurance business is assessed differently from that of general business. The income taxable from such a business is made up of an amount accruing to or derived by that person during the basis period from investments attributable to the business, as guided by the Income Tax Act 896, subsection 90. The income derived by a person from a life insurance business for a year of assessment shall exclude from the income the following items, and the items excluded shall not be regarded as consideration received for an asset or liability. Premiums derived by the person as an insurer or reinsurer. Proceeds derived by the person under a contract of reinsurance in respect of proceeds referred to in paragraph B, I, and B, not to deduct from the income the following items which are not to be included in the cost of an asset or liability. Proceeds incurred by the person as an insurer or a reinsurer. Premiums incurred by the person under a contract of reinsurance in respect of proceeds referred to in I. The expenses allowable as deductions for tax purposes from such a business are management expenses, including commissions paid to insurance agents to the extent insured by that person during the basis period in carrying out the life insurance business. The chargeable income for the life insurance business is referred as follows. Determination of chargeable income. Then you go on with your investment income or the interest and commission to sales agents, general administration expenses. So you deduct those commissions and administrative expenses. You get your net investment income. You subtract your capital allowance to get your chargeable income. If you are enjoying it, kindly subscribe, like, share, comment. You can also share an illustration so we all solve it together. So in the case of life insurance, the income bit is referred to as the investment income. But in the case of general insurance, the income bit is referred to as gross premium. Let's please know the distinctions.